You know, I get letters all the time from young people, 30 years old, just starting out, trying to figure out how to invest their money. And they ask me, Jack, what should I do? How do I build wealth? What mistakes should I avoid? And I always think back to when I was 30 years old, fresh out of Princeton, starting my career on Wall Street, full of energy, full of ideas, full of certainty that I was going to beat the market, that I was going to do something nobody else could do. I was wrong about a lot of things. And I've spent the last 60 years learning what I got right and what I got terribly, terribly wrong. So today I want to talk to you about what I wish I could go back and tell that 30-year-old Jack Bogle. Because if I could have a conversation with myself at that age, knowing what I know now, maybe I could have saved myself some pain. And maybe, just maybe, you can learn from my mistakes without having to make them yourself. I'm 94 years old now. I've seen booms and busts. I've seen recessions and bull markets. I've made millions of dollars, and I've watched others lose millions. I founded Vanguard. I pioneered index investing. I started a revolution in the investment industry, but none of that happened the way I planned it. None of that happened without mistakes. So let me share with you what I've learned, not theory, not what the textbooks say, what life has actually taught me. Lesson 1, stop trying to beat the market. The first thing I wish I'd understood at 30 is this: the market cannot be beaten, not consistently, not over the long term, and most certainly not by someone like you or me. When I was young, I was obsessed with beating the market. That was the whole goal. Find the stocks that would go up the most, find the manager who could outperform, pick the winners, avoid the losers. That was the game. And I was good at it, or so I thought. I had a system, I had analysis, I had confidence. I was a portfolio manager for Wellington Management, and I believed I could beat the market, and sometimes I did. Sometimes my picks were good, sometimes I got lucky. But over a full market cycle, over 10 years, 20 years, I underperformed. I watched the market go up, and I didn't go up as much, and I spent years trying to figure out why. The answer was simple, and it took me way too long to learn it. Fees, costs, the friction of trying to outsmart the market. Every trade I made cost money. Every decision I made was subject to error. Every bit of overconfidence cost me money, and all of that added up to underperformance. If I just bought an index fund at 30 years old, I would have beaten 90% of what I actually did over the next 30 years. I would have saved myself millions of dollars in fees. I would have saved myself countless hours of stress and analysis and research that led nowhere. So my first wish, if I could go back and talk to myself at 30, is this: stop trying to beat the market. Stop it right now. You're not going to do it. I'm not going to do it. The smartest people on Wall Street don't do it, except that you're going to get the market return, not more, the market return. And then focus on minimizing the costs so you actually capture that return instead of giving half of it to fees and taxes and trading costs. Lesson 2, your biggest enemy is not the market, it's yourself. The second thing I wish I'd known is this: the market isn't your enemy, you are. I learned this the hard way. Over and over again, I watched myself make terrible decisions because of emotion, not logic. I'd feel confident and buy too much. I'd feel scared and sell too little. I'd see a hot stock and chase it, even though I knew better. I'd panic in a crash and sell right at the bottom. This is what happens to almost every investor, and it happened to me too. We think we're rational. We think we're making logical decisions based on analysis, but we're not. We're making emotional decisions based on fear and greed. The market drops 10%, and suddenly I'm thinking, oh my God, it's all going to crash. I should get out. The market rises 20%, and I'm thinking, I'm missing out. I should invest more right now. Both of those decisions are exactly backwards. I should buy when everyone's scared. I should be cautious when everyone's greedy. But I couldn't do that. Most people can't, because emotion is stronger than logic. Fear is stronger than reason. So what's the answer? Automation, rules, systems that take emotion out of the equation. Don't make investment decisions based on how you feel. Make them based on a plan, a written plan, something you decide on when you're thinking clearly, when you're not panicked, and then you stick to it no matter what, even when it feels wrong, especially when it feels wrong. If I'd done that at 30, if I just set up an automatic investment plan and stuck to it through thick and thin, I would have been far better off than I actually was. The decisions I made in my head, the ones that seemed so smart at the time, almost all of them turned out to be mistakes. Lesson 3, fees are silent killers. The third thing I wish I'd understood is how much fees matter, how absolutely corrosive they are to returns. When I was 30, I didn't think much about fees. A 1% fee, that's nothing. 2% still seems reasonable for professional management. I wasn't paying attention to the fact that fees are taken every single year, and they compound, and they're taken whether the market goes up or down or sideways. If you're paying 1% a year for 30 years at an 8% market return, here's what happens. You start with $100,000. The market return is 8%, but you pay 1% in fees, so your actual return is 7%. Over 30 years, that compounds to approximately $760,000. But if you just bought an index fund with a 0.03% fee, your actual return would be 7.97%. Over 30 years, that compounds to approximately $920,000. The difference is $160,000 from 1% versus 0.03%. And that's just the direct fee. That's not counting the fact that high-fee managers typically trade more, incur more taxes, and make worse decisions, which adds another drag on returns. I wish at 30 years old someone had sat me down and shown me the math on that. Because once you see it, once you really understand it, you can't unsee it. You can't go back to believing that paying high fees for professional management makes sense. Lesson 4, time is your greatest asset. The fourth thing I wish I'd understood at 30 is the power of time. How much time matters. How every year you delay is a year you can't get back. When you're 30, you feel like you have all the time in the world. You've got 40 years until retirement. You think you can wait. You think if you start investing at 35 or 40, it won't matter. You'll still have time to catch up, but you won't. The math doesn't work that way. Let me show you. If you start investing $10,000 a year at age 30, and you keep doing that until you're 65, you'll invest a total of $350,000 over 35 years. At an 8% return, that becomes approximately $2.6 million. But if you wait and start at 35 instead, you invest the same $10,000 a year for 30 years instead of 35. You invest $300,000 total. Even though you invested less because you had 5 fewer years of compounding, you only end up with about $1.9 million instead of $2.6 million. The difference? $700,000 from just 5 years. Now imagine if you started at 40 instead of 30, or if you started at 30 but stopped contributing after a few years and thought you'd catch up later. You can't catch up. You can't make up for time lost. Time is your most valuable asset when you're young, and I didn't appreciate that at 30. I thought I had forever. Lesson 5, diversification is not a luxury, it's a necessity. The fifth thing I wish I'd known is the true power of diversification, not the fake diversification of owning 20 different mutual funds with overlapping holdings. Real diversification, owning the entire market. When I was 30, I thought diversification meant owning a bunch of different stocks that I'd picked. 5 stocks from technology, 5 from finance, 5 from healthcare. I thought I was diversified. I wasn't. I was just creating multiple opportunities to be wrong. Real diversification is owning thousands of companies, owning the entire market. Because when you own the entire market, you win when the market wins. You don't have to pick the winners. You don't have to avoid the losers. You own everything. The good companies, the bad companies, the boring companies, the exciting companies. You own it all. This is what index funds taught me. This is what took me decades to really understand. And once I understood it, everything changed. I founded Vanguard on this principle. Index funds own the market. Don't try to pick winners. Own them all. If I'd had that insight at 30 instead of 40 or 50, I would have saved myself so much wasted effort, so much analysis of individual companies that didn't matter, so much time spent trying to predict the unpredictable. Lesson 6, simplicity wins every time. The sixth lesson is about simplicity. Complexity is the enemy of returns. Wall Street loves complexity. Complexity justifies fees. Complexity makes it seem like you need professional management. Complexity makes it seem like investing is hard, but it's not. Investing is simple. Own the market, keep costs low, stay invested. That's it. That's the whole strategy. When I was 30, I didn't believe that. I thought there had to be more to it. There had to be some secret, some special knowledge, some way to gain an edge. I looked for it everywhere. I read everything. I analyzed everything. I thought about nothing else. And you know what? The simple strategy beat me every single time. The simple strategy of buying and holding an index fund beat my complex strategy of picking stocks and trying to time the market and analyzing companies and thinking I was smarter than the market. 30 years of complexity, and I lost to simplicity. If I could go back and tell my 30-year-old self anything, it would be this. The answer is simpler than you think. Much simpler. Stop looking for secrets. There aren't any. Just buy an index fund. Keep your costs low. Stay invested for decades. That's the whole game. Lesson 7, your biggest regret will not be about money. The 7th lesson is harder to talk about, but it's the one I think matters most. When I was 30, I thought money was the most important thing. I thought if I could just make enough money, if I could just succeed financially, everything else would fall into place. I'd be happy, I'd be fulfilled, I'd be important. It's 60 years later, and I can tell you that's not how it works. Don't get me wrong, I'm grateful for the money I've made. I've been able to do things with it that matter. I've been able to help people. I've been able to start Vanguard and change the investment industry. The money made that possible. But the money itself, it didn't make me happy. It didn't make me fulfilled. If anything, the pursuit of it cost me things that were far more valuable. I missed time with my family. I missed my kids growing up. I was so focused on work, on building Vanguard, on proving I was right and Wall Street was wrong, that I wasn't present for the people I loved. I can't get that time back. I can't get those years back. And now that I'm old, now that I'm 94, and I've got fewer years ahead than I have behind me, I think about that a lot. Not about the money, about the time. If I could go back and tell my 30-year-old self anything, it would be this. Make the money. Be smart with money. Build your wealth. But don't sacrifice the people you love for it. Don't sacrifice your presence for your productivity. Don't sacrifice your life for your legacy. Because when you're old, when you're looking back, nobody ever says, I wish I'd made more money. I wish I'd worked more hours. I wish I'd focused more on my career. They say, I wish I'd spent more time with the people I loved. I wish I'd been present. I wish I'd lived more fully. Lesson 8. The market will terrify you. That's when you should invest most. The 8th lesson is about fear and opportunity. The market has crashed many times in my lifetime. 1987, 2002, 2008, 2020. Every time investors panicked. Every time they sold at the bottom. Every time they locked in losses and missed the recovery. And every time it was the best time to invest. When I was 30 and the market had a bad year, I would feel the same panic everyone else felt. That instinct to protect myself. That urge to sell and get to safety. But I learned something over 60 years. The market crashes are not disasters. They're opportunities. They're the times when you should be most aggressive with your investing because stocks are on sale, prices are down. If you're going to invest the same amount of money anyway, why not invest more when prices are low, buy more shares, get more for your money? But almost nobody does that. Almost everybody does the opposite. They run away from the market when it's down. They buy when it's up. They sell when it's down. It's exactly backwards. If I'd understood this at 30, if I'd had the discipline to actually do this instead of just believing it intellectually, I would be far wealthier now because every single crash has been followed by a recovery. And every recovery has made people who held on, who actually invested more during the crash, significantly richer. Lesson 9, your plan matters more than your predictions. The 9th lesson is about the difference between planning and predicting. When I was 30, I thought the secret was knowing what was going to happen. Predicting the future, knowing which stocks would go up, knowing when the market would crash, knowing which sectors would outperform. I spent years trying to predict. I read everything, I analyzed everything, I thought about everything, and I was wrong about almost everything. But you know what? It didn't matter because I had a plan, a simple plan. And when I stuck to the plan, when I didn't let my failed predictions override my strategy, I did okay. The investors who did the worst were the ones who tried to predict and then acted on their predictions. They thought the market was going to crash, so they sold. It didn't crash. They missed the recovery. They thought interest rates were going to rise, so they moved their money. Interest rates didn't rise. They missed the gains. Over and over again, trying to predict and then act on those predictions led to disaster. But the investors who had a plan and stuck to it, regardless of their predictions, they did fine. They did better than fine. They got rich, not from being right about predictions, from being disciplined about their plan. If I could go back and tell my 30-year-old self one thing about this, it would be this: stop trying to predict the future. You can't do it. Nobody can. Instead, make a plan and stick to it. Your plan will make you rich. Your predictions won't. Lesson 10, the best is yet to come. The 10th and final lesson is about perspective. When I was 30, I thought the best years were ahead of me. I thought I'd make my fortune between 30 and 60. I thought once I got to my 60s or 70s, it would be downhill. The best years would be behind me. But I'm 94 now, and I can tell you that's not true. Some of my best years have been my recent ones, not financially necessarily. Financially, most of my wealth was made between 30 and 50. But in terms of impact, in terms of meaning, in terms of actually understanding what matters and why, my most recent years have been profound. Founding Vanguard was wonderful. Starting the index fund revolution was important. But getting to see the impact of that work, seeing millions of people benefit from lower fees and better returns, that's been extraordinary. And I'm not done. I'm still working. I still have things I want to accomplish. I still believe the best is